One chart to rule them all. This chart is perhaps the most important chart in the market right now, and it's broken into two parts. On the right-hand side, you see the S&P 500 going back to 1999. You can see the two big bear markets in 2000 and in 2008. And then you can see the largest bull market in American history that occurred from 2009 all the way up until very, very recently. Now, on the left-hand side is the yield curve, and the yield curve is just simply interest rates at different maturities. So on the far left-hand side of the chart, it's at 3 months, then it goes to 2 years, 5 years, 7 years, 10 years, 20 years, and 30 years. It is slightly positive at the very beginning of the curve on the left-hand side. It's actually slightly negative from 2 years to 5 years, and then slightly positive from 5 years to 30 years. It's really, really flat. And this is what's causing the problem in the stock market. You may think that it's trade war. You may think it's monetary policy, and it is monetary policy, but it's monetary policy because the Fed has been pushing up short-term interest rates, and at the same time, long-term interest rates have really not budged at all. So the Fed is responsible for the flattening of the yield curve. Hey everybody, Courtney Smith here with our December 10th edition of Wall Street Winners. Big things happening in the market. And this is the biggest thing of all. All right, here's the S&P 500. We're in a box. We're in what's called a rectangle formation. It's sloppy, choppy sideways. We've been there now for almost 2 months after we cracked in October. We've really gone absolutely nowhere. I think the best trading strategy is to buy a break upside out of the box and to sell a break downside out of the box. So this rectangle formation is giving us the parameters from within where to trade. This is the Dow, and if you look on the top corner, the red line has started to move up above the green line by a smidge, well, more than a smidge, and that means more selling pressure in the market than buying pressure. Down at the bottom, we don't have quite a perfect rectangle like we have in the S&P, but I've yellowed in a support zone. And if the Dow breaks below this support zone, Katie bar the door, you got to be short. You can't be long. Sorry for your pension plan. I'm really sorry for it. Similar situation in the Nasdaq, except with a slightly downward bias. A break below that low that we made in November, once again, kiss it goodbye. We're going to have to get up above, I would say, let's say 7,700, something like that, before we can get on the bull side with the Nasdaq. Now, there's a lot of things going on in here. So right now, our seasonality indicator is neutral and not even close to getting bullish. So we kind of got to kiss that seasonality goodbye. We're supposed to be in a really bullish period of time right now as we're drifting into December, and we're not getting it. Ned Davis research, bullish through December, through January. We're not seeing it. The yield curve, I started this broadcast out with that. This is what's crushing the market. People are freaking out about the yield curve because the yield curve is the best predictor of a bear market. And by bear market, I mean at least a 20% correction in the stock market. Now, this is the difference between 3-month bills and 30-year, and 45 basis points is very flat. Not enough to throw in the towel entirely, but as I showed you, from 2 to 5, it's actually already negative. So it's pretty darn flat now. Asset allocation, they bailed out of stocks. They just completely said, I give up the ghost. I need to go someplace safe. And where? Bonds. We always know bonds are going to mature at 100. So let's go buy some bonds and forget this stock nonsense. It looks garbagey. Stock market RISKDICATOR, another indicator that they're going to safe havens. They do not want to be in the stock market right now. Global shares down hard, breaking to new lows. This looks like a total piece of garbage. Now, I've been bored, but now I'm getting more interested because the global shares are leading to the downside. Why? Insurrection in France and near insurrection, let's put it this way, a political and financial crisis in Italy. Well, France and Italy are two pretty darn big economies. So if they're going to be in trouble, what does it mean to Portugal, Spain, Greece, some of the other weaker countries? Bonds exploded to the upside. Fully paid up members know we're already long bonds. We're already long safe haven stocks. So as a result, bear market? No, didn't really notice. Anyway, you can see bonds gapped up a lot. When bonds go up, interest rates are going lower. Now, these are bonds. So when interest rates go lower, that's one reason why we have a flat yield curve. The Fed is pushing up short-term interest rates. The market is pushing down long-term interest rates. Bond key factors, they're all saying we're going to have lower interest rates. That's pretty clear. The dollar. Now, if interest rates are going lower, that should hurt the dollar. So this pennant formation that we formed here should be broken to the downside. The only reason why I'm not really keen to go short the dollar is that the Fed is reducing the supply of dollars, and safe haven buying of dollars increases the demand. So increased demand for dollars for safe haven purposes, decreased supply because the Fed is shrinking the money supply is going to keep the dollar strong. But gold is being bought as a safe haven right now. People are basically saying we don't want to be in any currency. We particularly don't want to be in the euro because there may not be a euro. And gold indicators turn more bullish. I'd have to say the top indicator is still flat. The bottom one is flattening, but the middle one is flattening, but the bottom one is doing very, very well. So put me in the mildly bullish camp for gold, and for our fully paid up members, you'll know I'm going to start to tip my toe in the water there. Okay. Big story is that Saudi Arabia and Russia finally decided that they would cut 1 million barrels a day in production. The interesting thing to me is the market only went sideways after that announcement. 1 million barrels a day is a lot of barrels, and maybe they don't believe. The Saudis have actually been very honest. When they say they're going to do something, they do it. The Russians, on the other hand, are not so reputable or credible. But nonetheless, the announcement should have caused the market to go up more. It didn't. So if the market goes sideways on bullish news, that's bearish. And finally, Bitcoin. We've been the only ones who got you short. We told you when to short. And now we're down under 3,300. You can see the purple predictor is collapsing. It looks to me like we're going to be headed even lower. How low? Well, I've always said that it'll go down to below the cost of production. And one of the interesting things about Bitcoin is largely there's only two costs. One is the electricity to power the computers, and number two is the capital cost of buying the computers. So what's happening is that, and so let's break those down. The cheapest place to mine Bitcoin is about $1,000 per Bitcoin. In other words, the electricity to cool and run the computers is probably down around $1,000 per Bitcoin. And then, of course, the cost of computing power just keeps going down, 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 down. And the miners are not stupid, so they're going to get better and better at it. In other words, the cost of production is going down. We need to get to below the cost of production in order to choke off the miners so they stop mining. Because why? Because they'd be losing money. If it costs them $4,000 per Bitcoin and they can only get $2,000, they lose $2,000 per Bitcoin? No, they're going to turn off the machines. But what it looks like is we could be going down to the lowest cost producer, not the average. The average, we don't really know what the average is, but I've seen estimates of $4,000 or $5,000. But the cheapest are down around $1,000, and that may be where we're going to really choke off the production of Bitcoin. So stay short at this point. All right, listen. I'm in the process of putting together an updated version of this. And I'm not finished with it yet. I'll be finished with it in a couple of days. I'm going to ask you to please download it. I'm making it free and available to everybody for free because I want everybody to protect themselves and hopefully even profit from the coming financial crisis. Because of the shape of the yield curve, our timetable is accelerated. It's going to come sooner rather than when I thought it would come when I put this report together. So either send your name in to support at Wealth Builder LLC and we'll send it out to you, or keep looking in your email box for when we announce the new version of it. But it's all updated with additional information. You really must get it. It's free, so I'm not pitching you. I'm telling you, you need to do it for your own life. Stock Butler, please check it out. Great product. All right, freebies, love having you here. Fully paid up members, just hang in there. We got to dive into this. We also are going to dive deeper into this whole financial crisis story because of the accelerated time horizon.